The COMEX doesn't fail. The idea that they would have to go to the market and buy physical silver at any fiat price, that isn't the way it works. They said there's a club and you ain't in it. The good guys, the real producers, revalue very, very substantially just to reflect the current reality of this gold and silver price, not to anticipate higher prices. I was fairly public a few weeks ago about selling 80% of my physical silver. I did it for two reasons. I did it because gold for me is a savings asset. Silver was a speculation. I bought silver because it was hated. The price of silver fell from 80 to 50. That's still above the consensus silver price. Now for me, gold is a very different circumstance. I save in gold. 25% of the capital that I drew out of the sale of 80% of my physical silver went into physical gold.
Can you clarify whether this was physical bullion or PSLV shares?
Even Tether, they house their gold and silver in a private vault in Switzerland. They don't share the audit results with me. I don't want my security housed in a wallet that could be hacked.
How is India and China breaking away from the US metal markets going to affect our markets? Related one is Command 556 says, is the price variation on spot between New York and Shanghai a result of China being buyers and US being sellers?
The answer to the second question is I don't know. So let's get out. The answer to the first question is probably I don't know too. I suspect over time that metals are fungible, which is to say if one market finds a way to have a real plurality over another market, that the metal will chase the money. I'm reminded years ago when the Indian government put a big excise tax on physical gold and silver. And I talked to some Indian friends of mine who are, well, I would call them traders. The Indian government would call them smugglers, about the impact of the excise tax. And they said, well, we hope they increase it. And I said, well, how does that work? They said, well, it costs us 2.5% to get gold from Dubai to India. And we sell it without the tax. The government has basically built in a 12.5% margin for us. That tells us that over time, disparities in markets are solved by informal means. Not in the near term, but in the longer term. I would note, too, that the recently publicized pronouncement by the Chinese government that they were going to limit the exports of silver to their licensees was less about limiting silver and much more about rewarding their friends. They immediately awarded 42 export quotas to people who I suggest were probably fairly close to the regime. It's important that you understand their news in context.
Now, in the context of reducing risk and looking at asset values, we've talked about being able to use Battle Bank for taking out equity loans against precious metals. Here's a related question from Just Told Joe 9328. Rick has stated that he prefers gold to hold his savings, but does he see any other physical assets such as farmland to be options as well?
Policy shifts sound dramatic, but capital always finds the weakest gate. Rick Rule admits uncertainty here, and that honesty matters because cross-border price gaps rarely last when arbitrage exists. A 12% tax spread versus a 2.5% transport cost practically guarantees grey market flows. That's Econ 101, not conspiracy. When 42 Chinese export quotas quietly favor insiders, it signals political allocation, not free pricing. For investors, that means short-term volatility, but long-term convergence as metal chases the money, just as Rick Rule implies. Next, the conversation shifts from global flows to what actually protects your savings when policy games intensify.
I own, relative to most people, a fair bit of farmland. I don't stretch fences or plow. I own farmland, which I lease to people who are good at it, who like it. And I consider it to be a superb asset class. I myself have always owned land with attendant water rights because I think water is a misplaced asset, and I think controlling the water enhances the value of the farmland. And I've been able to prove that, by the way, in the rents I charge. So yes, I consider high-quality farmland with attendant water rights to be a very good long-term investment. I have similarly had very, very, very good luck with timberland. Understanding that to realize the value in timberland, you must be prepared to hold it for a very long time, which I have been. In the case of both my farmland portfolio and my timberland portfolio, I suspect that the sell decision will be made by my heirs. In other words, it won't occur in my lifetime.
A pair of related questions here, and then we can move on. Nitro Burp 2694 says, no one seems to talk about GATA anymore, the Gold Antitrust Action Committee. They were going after the CME and the COMEX. When will we see justice? And then Buck 40 Pool Genius says, if the COMEX ever does really fail, does it really make a difference? Or does the COMEX ever really fail? And if so, does it make a difference?
The COMEX doesn't fail.
Real wealth often hides in boring assets Wall Street doesn't promote. Rick Rule emphasizes farmland with water rights, and that's critical when global freshwater demand is projected to exceed supply by 40% by 2030. Leasing productive land creates yield plus inflation protection, a rare combination today. Timberland, held across decades, compounds biologically even when markets stall. For investors, this isn't about hype, it's about durability beyond quarterly earning cycles. Rick Rule's multi-generational mindset contrasts sharply with traders obsessing over daily COMEX drama. What comes next challenges the popular narrative that gold's past was one long suppression scheme.
Listen, the GATA guys are good friends of mine. I enjoy them. I enjoy the fact that they enjoy debate, often with me. I don't believe that markets have been artificially suppressed in the long term. Markets are manipulated all the time. Markets as big as the Treasury market are manipulated. Traders manipulate markets. That's what they do. This spoofing that you've seen will never quit, ever. But the idea that there was a 40-year-long conspiracy to depress the price of gold while the U.S. dollar was strong flies in the face of arithmetic. It's convenient for people who made the wrong bet psychologically, but it's silly. GATA has been reduced in importance in terms of the public debate around the gold bugs because the gold price has gone up. You don't need to blame anybody. I mean, the gold price as recently as the year 2000 was at $256 an ounce. Now it's at $5,000. Some suppression. Now, as to COMEX, this fantasy that the sort of Reddit crowd had that they were going to teach J.P. Morgan Chase a lesson by squeezing physical supplies suggests that these people don't know very much about the law. The exchange is owned by the exchange members.
If gold rose from $250 in 2000 to $5,000 today, suppression wasn't exactly effective. Rick Rule separates short-term manipulation from long-term price trends, and that distinction matters for serious investors. Yes, spoofing happens. Regulators have fined banks billions, but arithmetic shows a 20-year bull market. Blaming a 40-year conspiracy often masks poor timing decisions. Structurally, exchanges are member-owned, limiting the fantasy of retail, taking them down. As Rick Rule implies, understand market plumbing before betting on revolt. Up next, the mechanics of force majeure and cash settlement reveal how power really operates in commodity markets.
You saw imbalances in the tin market. What did the exchange do? They declared force majeure and they cash settled.
And nickel, they rolled back trades. Yeah.
Correct. The idea that you're going to catch J.P. Morgan or Loeb or Conti or Cargill or any of these guys short is nil. You might face them into an ugly cash settlement, but the idea that they would have to go to the market and buy physical silver at any fiat price, that isn't the way it works. You know, I forget who it was, but they said there's a club and you ain't in it. So please understand that. The consensus metals prices on Wall Street and Bay Street around gold seem to cluster in the $3,200 to $3,500 an ounce range. Now, it seems to me if you make the stuff for if you sell the stuff for $5,000 and your earnings forecast is based on 3,500, that arithmetically you're pretty likely to surprise folks, and the surprise is likely to be good. Similarly, if you're doing a net asset value calculation of future cash flows and discounting it back at Wall Street's prevailing 5% discount rate, and you're using a $3,500 denominator, which is to say a $3,500 gold price in a $5,000 world, that you are understating the value of that company fairly substantially. If the gold price doesn't fall fairly substantially, it would seem to me that the good guys, the real producers, revalue very, very substantially just to reflect the current reality of this gold and silver price, not to anticipate higher prices.
Retail imagines a squeeze, but exchanges can rewrite rules mid-game. Rick Rule highlights force majeure and trade rollbacks. Reminders that clearinghouses protect systemic players first. If analysts model gold at $3,500, while spot trades near $5,000, earnings estimates are structurally conservative. A 30 to 40% pricing gap in NAV calculations can materially understate minor valuations. That's not hype, that's discounted cash flow math. Rick Rule's point is subtle. Repricing can occur without any new bull market, just updated assumptions. And what he says next reframes speculation versus savings in a way most portfolios ignore.
I was fairly public a few weeks ago about selling 80% of my physical silver. I did it for two reasons. I did it because silver occupied a speculative position in my portfolio. Gold for me is a savings asset. Silver was a speculation. I bought silver because it was hated. You'll recall, Dunnigan, in our earlier interviews, when I described silver as a coiled spring, that when the hate dissipated, it would be easy for the price to double. Well, it didn't double. It went up fivefold, sixfold. When that happened, the reason that I owned my silver went away. I owned it as a speculation. And I had to decide, was it still the best speculation in my portfolio relative to the amount of capital I had tied up, or was there something better to do with it? And I decided for half the money that was in my silver portfolio that I'd rather buy the silver stocks. Because if silver didn't go up anymore, by definition, I couldn't make any money. If silver did go up, the silver stocks would go up too. But if silver just went sideways, the silver stocks would go up by 50%. That seemed like a better speculation to me. For me, it's all about arithmetic. Ironically, if the price of silver fell, while the price of the silver stocks would fall, the values wouldn't need to fall very much because the net present value assumptions were made at a $45 silver price. So if the price of silver fell from 80 to 50, that's still above the consensus silver price that people have used to calculate those net present values. So it seemed to me like I had a better speculation in the silver stocks than the silver.
When an asset rises fivefold, the risk-reward math quietly flips against you. Rick Rule makes it clear this wasn't emotional. It was arithmetic after a massive move. If miners are modeled at $45 silver and spot is materially higher, operating leverage can amplify returns even in a sideways market. Historically, quality silver equities have shown 1.5x to 3x beta to the metal itself during bull cycles. For portfolio construction, that's capital efficiency, not speculation. Rick Rule is signaling discipline. Harvest gains when the thesis matures. And what he does with those profits next reveals how he separates wealth building from wealth protection.
Now, for me, gold is a very different circumstance. I save in gold. So 25% of the capital that I drew out of the sale of 80% of my physical silver went into physical gold. Because I wanted to take some of my speculative gains all the way off the table and get them out of harm's way. And as you know, Dunnigan, since the year 2000, I've maintained liquidity in US dollars, but I've saved in gold. I regard them personally for myself as very different assets or asset classes. I don't know how your customers feel about it, but that's how I feel about it.
Most investors say they diversify, but few truly separate speculation from savings. Rick Rule draws a hard line. Silver trades, gold stores. Since 2000, gold has compounded roughly 8 to 9% annually, quietly outpacing inflation while preserving purchasing power through multiple Fed cycles. Moving 25% of gains into physical gold is risk compression, not retreat. Liquidity in dollars, savings in bullion. That's asset liability matching in uncertain rate environments. Rick Rule is modeling behavior many retirees and long-term investors overlook. Next, the conversation turns to convenience versus control in how metal is actually held.
Rick, it's been widely reported that you've sold your physical silver to buy miners. Can you clarify whether this was physical bullion or PSLV shares? Thank you.
That's a good question. I sold my PSLV because it was so easy. I don't have to call Dunnigan. Dunnigan doesn't have to find a bid. I don't need to take it out of a vault. I can sell my PSLV with a click of a mouse. I still have my physical silver, partially because I'm lazy.
Well, okay, this is a related question to that last one. We'll get back to the main thread in a moment. But Bill M. from Florida says, Rick, to use physical gold and silver as collateral for borrowing, are you concerned that tokenized gold could be so much easier, cost-effective, and safer on a blockchain ledger than to do with your bank arrangement with Brinks? Peter Schiff appears to think so.
2 years from now, when real tokenized gold and silver appears, when they are delivery receipts that are housed in institutions like Brinks that are publicly traded or in the Royal Canadian Mint, my belief is that the technology will exist so that Battle Bank can charge against gold tokens. Right now, the only form of security that I feel comfortable with my customers having in their own accounts are not tokenized metal, but rather metal itself. With the technology that exists today and the regulatory climate that we have today,
liquidity and security are not the same thing, even if both trade on a screen. Rick Rule chose to sell PSLV for ease, but keeps physical metal for control. That distinction matters. ETFs offer intraday liquidity, yet counterparty layers still exist within custodial structures. Tokenization promises efficiency, but regulatory clarity lags. Even in 2022 to 2023, crypto custody failures exposed structural fragility. For collateral, legal enforceability often outweighs technological elegance. Rick Rule is prioritizing jurisdiction and law over speed. What follows digs deeper into why transparency and audit trails may matter more than innovation.
Even the Tether instrument, which is fairly liquid, doesn't work for me. I want my repository to be surrounded by a body of precedent and a body of law that I know my rights. And I don't want my security housed in a wallet that could be hacked. So given the current state of technology, I want my collateral. Listen, I own gold and silver, gold in particular, because I want to worry less, not worry more. And the idea that I would superimpose another level of worry is not something I'm interested in. I believe 2 years from now, 2.5 years from now, the technology exists today, but I believe the regulatory protocols will exist that will have a coin that is a securitized depository receipt housed in a depository institution that I can trust. Even Tether, I know these guys. I have a high degree of regard for them. They house their gold and silver in a private vault in Switzerland. They don't share the audit results with me. The vault isn't in a publicly traded company. I don't think publicly traded companies are superior, but in a publicly traded company, I can see the income statement and the balance sheet on a quarterly basis. In other words, I know that my vault will continue to be in business and that the steward of my gold and silver won't be a bankruptcy court somewhere. I'm very picky. I'm very picky about how I store my savings, and I'm very picky about my collateral.
Innovation moves faster than regulation, and investors often pay the tuition. Rick Rule stresses legal precedent over digital convenience, a lesson reinforced after multiple crypto collapses wiped out billions in 2022. Transparency through audited financials and public filings adds a measurable layer of oversight that private vaults may lack. Liquidity without enforceable claims is fragile collateral. For conservative portfolios, counterparty risk is as critical as price volatility. Rick Rule is reminding investors that custody structure can matter as much as asset selection. The final point brings this back to a simple principle. Risk should decline, not rise, when you buy protection.
And right now, my collateral has to be physical metal with an established precedent, an established body of law, and it has to be in a facility where I know, if not love and trust, the fiduciary. If the owner of a private vault lies to me, I can sue that person. I can prosecute him for fraud. If Brinks lies to the SEC in a filing statement, that's a felony. It's not Rick Rule's beef. It's Brinks v. the SEC. And that's important to me. I do not own gold to increase my risk.
True safety is enforceable, not theoretical. Rick Rule anchors his strategy in legal recourse, the ability to sue, prosecute, or rely on SEC oversight if disclosures are false. That's a structural safeguard many retail investors ignore when chasing yield or convenience. In markets where custodians hold trillions, trust is reinforced by regulation and quarterly reporting requirements. Physical collateral within a recognized legal framework reduces tail risk. Rick Rule's closing message is simple. Protection should lower uncertainty, not layer on new vulnerabilities.